Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. First question is from Jill. She says, I'm diversified. I'm invested in mutual funds. I have 401k. I feel like that's pretty good. It's a pretty good amount of different assets that I'm diversified in, so I'm protected, right? All right, Jill, you bring up a crucial point about diversification, and it's great that you're thinking about it. Mutual funds are indeed a common choice for diversifying investments, especially within retirement accounts like a 401k. Now, it's clear you're comfortable with mutual funds, having been familiar with them throughout your career. However, let's delve a little bit deeper into whether your current setup truly provides the diversification and protection you seek. First, mutual funds come in various types: stock funds, bond funds, and within those categories, there's like further divisions, right? Government bond funds, corporate bond funds, municipal funds, bond funds, all those kind of things. So understanding the composition of each fund is key, because true diversification isn't just about having multiple funds. It's about ensuring they cover different sectors, asset classes, and geographical regions. For example, if you have several funds that mostly track large cap US stocks like those in the S&P 500, you might not be as diversified as you think, because they likely hold many of the same companies. Overlap is another consideration. Many mutual funds, especially index funds, replicate the holdings of popular market indices like the S&P 500. So this means there could be significant overlap among your funds where they hold similar stocks or bonds, thus reducing the actual diversification benefit that you might expect from having multiple funds. Now, moreover, while mutual funds provide a convenient way to invest across a broad spectrum, they also come with inherent limitations and risks. For instance, their performance is influenced by fund managers' decisions and market conditions, and they typically come with management fees that can eat into your returns over time. In assessing your portfolio's adequacy for protecting your retirement income, it's important to consider not just the number of funds you hold, but also their underlying holdings, their performance history, and how they align with your risk tolerance and retirement goals. So that was a great question about diversification. If you would like to send in your question, I'd love you to do that. You can email it. You can email it to poollocke@poollocke.com. Let's get to our second question today. This question is from Carl. Carl says, I have an advisor who said he wouldn't put me in mutual funds because of those hidden fees that you mentioned, but he did put us in ETFs. Is this okay? All right, Carl, that's a thoughtful question. And it's great that you're aware of potential impacts of fees on your investments. Now, ETFs, exchange-traded funds, can indeed offer several advantages over traditional mutual funds, especially when it comes to transparency and cost-effectiveness. So your advisor's choice to steer away from mutual funds due to hidden fees and opt for ETFs might be beneficial, depending on the specifics of the ETF you're invested in. So ETFs, like mutual funds, come in various types. There are passive ETFs that track indices like the S&P 500, which typically have lower management fees because they aim to replicate the performance of the index rather than actively manage investments. On the other hand, there are actively managed ETFs where the fund manager makes decisions to try to outperform the market, which often come with higher fees due to the active management involved. One of the key advantages to ETFs is their ability to be traded throughout the day on stock exchanges, unlike mutual funds that are traded once daily after market close. So this flexibility can be advantageous if your advisor needs to make quick adjustments to your portfolio based on market conditions. However, it's essential to consider whether the ETFs you're invested in are truly benefiting you in terms of reduced fees and enhanced performance. While passive ETFs generally have lower fees compared to actively managed mutual funds, some ETFs may still have underlying costs that can erode your returns over time. If your advisor is charging a management fee on top of the ETF's expense ratio, it's crucial to assess whether the combined fees are justified based on the level of active management and personalized advice you're receiving. Now, in many cases, advisors may charge a similar management fee regardless of whether they manage mutual funds or ETFs, which means you could potentially be paying more for a service that requires less active management. Now, it's always a good idea to have a candid discussion with your advisor about the fees you're paying and what value-added services they provide in return. So this transparency ensures you're making informed decisions about your investments and optimizing your retirement income strategy while keeping risk and volatility in check. Hey, thanks for the awesome questions. As always, if you'd like to send in your question, you can do so. You can email them to poollocke@poollocke.com. And if you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the